Thanks for joining us on Parliament. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Indian markets extend losses with Nifty trading below the 10,700 mark. All sectoral indices except energy and infra trade in the red.
Lenders will get a majority stake in Jet Airways after the airline issues 11.4 crore equity shares to them. Jet also posts its fourth straight quarterly loss.
The government has hiked the MSP for sugar by 2 rupees to 31 rupees per kg to ensure that they repay their dues to farmers on time.
Dr. Reddy's falls 30% in intraday trade after the US FDA letter on its Bachupalli plant with 11 observations is made public.
India revokes Pakistan's most favoured nation status and urges other countries to isolate Pakistan after the Pulwama attack.
We'll get to all the stories in a moment, but first, a quick check on how the markets are faring right now. Yatin is here with a closer look on some of those stocks.
Afternoon, Harsha, and we are, almost 100 points down on the Nifty. For the past few days, there has been extreme selling pressure on mid caps and few smaller companies. If you look at the advance decline ratio on Nifty 50, one stock advancing to 4 declining. So the market breadth is extremely weak at this point in time. If you look at the losers list, Dr. Reddy's, of course, after the lapses were found at the Bachupalli plant and the 483's public is down 8%, went down as much as 30-35% in intraday trade, probably because of a fat finger. JSW Steel, Sun Pharma, Hindalco are the other stocks which are losing anywhere between 4.5% to 5%. On the flip side, the gainers list, we have energy stocks. So we have the likes of NTPC, doing well, and also Power Grid is one stock which is almost 4% up in trade. BPCL and GAIL are the other oil marketing companies which are gaining anywhere between 2.5% to 3%. What's in focus is the entire pharma pack. So the likes of Divi's Laboratories, after the company in a statement to stock exchanges said that there have been some IT searches conducted at the premises, is down 5%. Similar is the case with Glenmark, which is down 8%. Dr. Reddy's right now is down another 8.5%. So the pharma pack is under extreme pressure for trade. And if you look at other stocks like Yes Bank, after the move yesterday, that stock is also down nearly 3% in trade.
Yatin, thanks so much for that. Let's get to Jet Airways. The lenders are planning to take control of the airline. The board yesterday agreed to a debt restructuring plan, which includes issuing equity shares to the creditors. Somit Sarkar is standing by with the details and how this is intended to work. Somit.
So let's go through the announcement step by step. So firstly, yesterday the board has approved the resolution plan put up by the consortium of banks. Now, according to this consortium of banks, there's a funding gap of close to 8,500 crore rupees in Jet Airways. And as the company is unable to repay this debt, lenders have agreed to convert that debt into equity. So now they will be seeking shareholders' approval on Feb 21st to issue nearly 11.4 crore equity shares to lenders at just 1 rupee. Now, why 1 rupee? Because of RBI circular, which says that lenders can convert that debt into equity at 1 rupee when the book value of the company is negative. Now, in Jet Airways case, the net worth is negative. That's the reason the lenders can convert that debt into equity at just 1 rupee. Now the company will be seeking shareholders' approval on Feb 21st to issue this, to convert this debt into equity and to increase the authorized share capital. So what does this mean now? Firstly, when they say that there's a funding gap of around 8,500 crore, it actually means that largely the entire debt of Jet Airways is unserviceable, because post the second quarter earnings, the company had said that their gross debt is close to 8,400 crore rupees. Now, this was not expected because we all knew that company needs fund and there is some funding gap in the company, but we never knew that the entire debt of the company would be unserviceable and unviable. So that is something negative and something new that has come in now. Secondly, because of this conversion of debt, there would be a significant dilution. Now, the issue of 11.4 crore equity shares to lender would give them close to 50.1% stake in the company. Now, this would bring down Naresh Goyal and Etihad stake in the company to around 25.5% and 12%, while that of the minority shareholders, that would come down to around 12.5% from 25% currently. Also, the conversion of this debt into equity at just 1 rupee represent that there is no value left in the company, which is actually not the case when it comes to Jet Airways. However, despite all these announcements, there is still more clarity that an investor would need. Firstly, the announcement only says that they will meet the funding gap requirement. There is the 8,500 crore gap requirement via debt restructuring, fund infusion, and various asset sale. Now, we all knew that they were supposed to meet this funding gap through these requirements, but what actually should have come out as clarity clarity on the timelines and more details on this plan, which has still not come out. Secondly, if you see, the lenders will be issued around 11.4 crore shares, but how much of this debt will be converted into equity, that is still not clear, and no one knows about this. At yesterday's market price, if you see, the value of this 11.4 crore equity shares is close to 2,600 crore rupees. So we'll need more clarity on this. Thirdly, and the most important one that one needs to know is how much fund and who will bring the fund that Jet Airways need to sustain their operations, because Jet is in desperate need of cash to sustain its operation. So that is one important thing that one has to know, and still there's no clarity on this. So the company will be holding their conference call today at 4 p.m. So let's see whether the management can answer these questions and give more clarity on queries that are still remaining to be answered.
And the latest quarterly numbers also doesn't behave any confidence, right?
Nothing great has come out from this earnings. The company has reported losses because of lower passenger growth and higher cost structure. Now, this is the fourth consecutive quarter where the company has reported losses. In Q3, the losses were close to 600 crore rupees, and this is despite the fact that its peers have managed to report profits in this quarter. Now, this is because of Jet Airways' high cost structure, which has also weighed on its core performance. Now, if you see the company's revenue minus cost per available seat kilometer, which represents the core per unit performance of the company, that is yet again remained negative in the third quarter, and it was close to 0.8 rupees per kilometer per passenger on the negative front. Now, this is despite the various cost saving initiatives taken up by the company, which should have actually reduced the cost for the company and helped this number also come down, but that has not happened for the company so far. Now, if you see the cost breakup of the company, now this rise in cost is not only because of higher fuel cost. The company's cost excluding fuel has also increased by around 13.5% compared to last year to close to 3.43 rupees, which is not at all encouraging given the fact that companies have been saying that they have taken various cost saving initiatives. However, on the positive side, the yields of the company did improve in this quarter, but that was an industry-wide phenomena and not only particular to Jet Airways. Lastly, if you see this chart, this clearly shows the pain point of Jet Airways. Now, here if you see the passenger growth on the international route for Jet Airways has been close to 8%, has declined by nearly 8%, but still the revenues have been higher by 8% on international routes. But on the domestic side, the passenger growth has declined by nearly 5%, and the revenues on the domestic side has declined by nearly 7% compared to last year, which clearly shows that they're still incurring losses, and there's still pricing pressure that they have been seeing on the domestic operations of the company.
Thanks so much, Somit, for that. Let's keep that conversation going. Joining us on the phone line is Kapil Kaul, Chief Executive Officer for the Indian Subcontinent and Middle East at CAPA. Kapil, thanks so much for taking our call. Your first thoughts on what was announced or agreed upon yesterday? There are still, fine print that has to be worked out, but the broad resolution is as per expected?
Yes, as per expected. Good afternoon. The expectation that it will be a bank-led restructuring, perhaps to me, was the only option. I don't think there was any other option at this stage. So the bank-led restructuring will give time to the airline, subject to change of the board and governance and possibly bring in more people at the top. We'll give them a time to restructure. Most important, I believe that they have the ability to restructure their costs significantly, and there's a possibility to improve revenues as well. So Jet's turnaround is feasible, and it could possibly happen in 12 to 18 months or 18 to 24 months. So I think the other aspect for banks to realize is there is a strong brand equity in the company, great customer loyalty, a significant brand. And when you get deeper into their business plan, there's so much of cost saving feasible and the revenue improvement possible. So I think the confidence is more about the business subject to improvement of governance, and which has led to this plan. So I would think that there's no other option. Banks had to take that lead, and our expectation is that the lead taken by the banks is limited. We don't see them holding the airline for long. It is an interim arrangement before a new ownership order emerges. But for the interim, this is the best rescue package that could have been structured.
Okay. Kapil, hi, this is Harsha. This reminds me of what happened in Kingfisher when banks came in and converted debt into equity, recapitalized them further as well. Does this, in a sense, solve Jet's immediate problems? And secondly, where is the money going to come from?
So I think Kingfisher's restructuring of banks was at a time when the aviation was going through a very, very tough period. Oil, demand, there were very other infrastructure and regulatory issues. It was a period where the outcomes couldn't have been anything else than what had happened. But in this case, I think the airline industry and the aviation industry is significantly changed. There's a potential for a massive upside as we go forward. The dynamics on ground relate to this transaction led by banks is much better. Second, as for the funding shortfall of about 8,500 crores, it has to be met with the fresh equity. Our understanding was that they need about $500 to $600 million of equity. They would monetize some of the aircraft assets they have. A recent assessment that we had done, there will be about $350 to $400 million of sale and leaseback opportunities available. It may not happen immediately, but over a period of time. So that monetization could happen. And of course, the banks will have to convert significant portion of the debts into equity. So I think there would be ways and means to address the funding gap. What's important is that they have actually ensured that looked at the business possibly a little more deeply. And the funding gap would take them, if the funding of about 8,500 crores realized, it will give them an opportunity to turn around, gives them about a couple of years to move ahead. So, but there are other measures available with Jet. As I said, equity infusion. You could see another Indian partner coming in. We are already hearing there could be a financial institution who will come in. And the banks will convert debt into equity, and some of the fleets will be monetized. So it's all doable, I would think. Jet's turnaround is doable, and I'm glad that the banks have taken lead, realized that such a large enterprise with so many people critical to economy should be saved, and I think this is the right decision.
A couple of follow-up questions to things you alluded to. You said a new ownership structure will emerge. You also said that there could be financial institutions that could come in. So you do think that there is a possibility that apart from either Naresh Goyal or Etihad, there would be other investors who would be willing to buy this equity of banks? Because, you know, all of us have been wondering whether they're making a mistake. The banks are making a mistake by converting and holding almost 50% in an airline with no clarity on who will come in and then subsequently buy this equity.
My understanding is that the banks will hold 51 along with another, possibly a government-led financial institution. This is my understanding. Maybe more clarity will emerge maybe by this evening or tomorrow or possibly next week. And the 51% they are going to hold is not going to be holding for long. So I think it may be pretty soon that at a certain point of time in the near term, the banks get out of that and the new investor comes on board. So I think this is an interim arrangement. I don't see banks holding Jet Airways for long, and they shouldn't hold Jet Airways for long. The circumstances dictated that they lead this restructuring. They've done it, and I am glad they did it. But circumstances also necessitate that they create a good governance structure at the board, quality of board of directors, create a very strong governance architecture, maybe some changes in management, and create an oversight which can lead them very quickly to get a new owner on board. So I would see that in the next about 12 to 18 months, Jet's ownership would be very different from what it is now.
Okay, Kapil, one other follow-up question. From what you have seen of Jet's financials, what to your mind is the sustainable portion of the existing debt? I ask in the context of how much debt should get converted into equity for Jet to be in a position to regularly service the remaining debt.
If we are looking at an 8,500 crore funding gap, assuming the monetization of fleet will happen over a period of time, I'm looking at roughly about 3,000 crores plus of the current debt getting converted. 2,500 to 3,000 crores is my estimate, because I see an equity infusion of about roughly $500 million coming in, and rest would come through the monetization of the current fleet.
Kapil, you've been tracking the sector for a very long time. I have a slightly bigger question, and this is about, Air India has been in trouble for a long time now. Indigo is having problems of expansion, and Jet is in financial trouble. At what point is this industry going to mature?
Well, I think that's a very good question, Harsha. We've been trying to find this for 15 years. There are pockets where things improve and then we get back to a downside. But there are two critical things that are likely to happen, and that could be a turning point for the industry. One is that there is a rapid refleeting that the airlines are doing to Neos and Maxes, going to deliver almost 10% operating cost benefit. I'm not talking fuel cost, operating cost benefit. We are also hoping that the ATF gets included in GST. Once that's done, that gets another 10%. a combination of refleeting and inclusion of ATF and GST would roughly give them 20% operating cost benefit. I think that will be the biggest anti-cyclical structure that will be creating for airlines. And if they improve utilization, improve productivity, get some technology digitalization of the back end, where I see a lot of finance cost and back office cost can be reduced, we could be looking at, if not in FY19, FY 2021, we could look at a structurally positive direction for the industry, which is fundamentally solid. So there is an opportunity that will present itself that airlines can fix their core, if not all of them, but some of them. So we see that, if not from FY20, but from FY21, that may happen.
Kapil, we'll leave with that. Many thanks, Reed, for joining us with your views. Kapil
Thanks.
Kaul from Kappa India, an aviation expert. The government, meanwhile, has increased the minimum selling price of sugar to 31 rupees per kg from 29 earlier. This move is expected to bring much-needed relief to mill owners and help them clear cane areas. Pratik Parija of Bloomberg News now joins us with more details. Pratik, how does this change the dynamics for the sugar sector?
No. So basically, what is the minimum selling price is the prices at the factory gates shouldn't go below that level. So they had, for the first time, India had set up a price like that last year, but that was not adequate for the sugar mills. That's why they had asked for an increase to 35 to 36 rupees per kg at the factory gates. So government finally, after deliberations, they have increased it to 32 rupees. 31 rupees, which in a way will help sugar mills to pay farmers on time. So areas that stands at more than 20,000 crore rupees as of today will reduce by the end of the season. Hence, mills, it will basically help farmers, So that was the reason behind the increase.
Okay, Pratik, thank you so much for joining us with those details.
The MSP hike, however, is less than what the millers had demanded. So will this be sufficient to ease their financial strain? We asked that question to Atul Chaturvedi of Sri Renuka Sugars. Listen in.
Still work in process. So the industry was demanding close to about 5 or 6 rupees per kg, which would have taken care of the profitability of the industry. And let's face it, if the industry is healthy, so would the farmers be. But whatever the government has done is a step in the right direction.
Okay, let's talk about Dr. Reddy's now. Dr. Reddy's fell 30% intraday today before making up for some lost ground after the latest Form 483 issued by the US FDA became public. The letter came after the pharma watchdog conducted inspections at one of Dr. Reddy's biggest plants in Bachupalli in Telangana. Darshan is here to tell us how significant these observations are and how serious they are, in fact.
Yeah, so there are 11. So the company already a while back had indicated the fact that, they received a Form 483 with 11 observations. What has happened today is that information has become public. We have access to that document. Now, 11 anyway is a large number, but 4 of them are repeat observations. So that's the big concern that the market has. And out of the 4, 3 are actually repeating to the one that actually had in 2017, and one of them was a repeat both on 2017 as well as 2015. Now there are 4 observations, and 4 of them first of all relates to quality, the control department. One of them leads to the laboratory department. One of them again leads to procedural equipment, and the 4th one leads to a lot of computer as well as procedural in nature. So as of now, if you look at the numbers and the clear indication of them, there's no indication of any kind of data integrity, but nevertheless it's important. 11 is a large number because even in 2017 they got 11 observations, and a 4 repeat observation won't be taken lightly by the US FDA.
And this is all for products sold in the US?
Yeah, that is for the products sold in the US. And I'll tell you why this plant is important, because formulations, 45% of their US revenues comes in from this plant. So it's an important plant. So what they're selling in, a lot of their future filings are filed from this plant. So that makes it more important. And Dr. Reddy, anyway, 2 of their plants are still under warning letter. That was the Duwada plant and the Srikakulam plant. So they are reeling under pressure there. Again, one more plant, that's what the market does not like at this point of time. Analysts also also say that, Jeffries has indicated that this will take time. They will take time in remediating this entire issue, and that probably will push back future filings also. Edelweiss is saying that even though these are all procedural in nature, they don't see this any kind of escalation, as there's no data integrity issues that are there. They said they spoke to the management, and the management believes that this can be addressable, but we've seen time and again how the FDA works and how much time it takes. Some of them have not been cleared even after 5, 7, 10 years, so it will take its own sweet time.
Darshan, thanks so much for that. 14 fund houses saw their assets erode by about a tenth since September when risk aversion and a credit crunch took hold in the markets. Sajid Mangat is here with us to tell us which schemes and which fund houses were hurt the most. Sajid.
That's right. We did the analysis of 44 fund houses from a period of October to January end, and at the end of that, we found out that the debt AUMs of 14 fund houses have fallen by roughly more than 61,000 crores. These 14 fund houses account for 50% of the total debt AUMs of the industry. Among the major ones which have been hit is DHFL, Pramerica, Indiabulls, Edelweiss, and Invesco, and DSP mutual fund. What the primary reasons is of outflow of asset from liquid to it's a flight of safety, to be clear. From medium and small mutual funds, the money has moved out to the top 3 mutual funds as a result of that island of scare and resulting credit crunch that happened in the market. And benefits have been reaped by some of the top 3 mutual funds like SGFC, ICICI Bank, ICICI Pru mutual fund, and SBI. We've seen their assets going up in that period of time. If you look at some of the scheme-wise or debt scheme-wise breakup, you see, to give you an example, DHFL Pramerica saw 73% of its assets wiped out or redemption happening to the assets in liquid schemes. For fixed maturity, it was around 16%, and for other debt, which is the bond funds of theirs, that's so nearly 56%. DSP was another one where we saw some kind of redemption happening. 32% of its liquid schemes, 32% in the liquid schemes saw redemption, followed by 21% in the other debt schemes, which saw some redemption there. Largely, it was a issue of credit or money which was parked by institutional investor taking a safer bet in terms of more established and bigger players going into that. Post that, what fund managers have told us that there is been a net outflow happening from the industry as well. We saw December net outflow happening in liquid schemes. That hasn't come back into the industry much, and in the first 2 weeks of February we have seen further there hasn't been much pickup in the liquid schemes, not much money coming in, so investors are parked in some of the major ones, but there's no fresh money coming in, and some of the investors who were earlier parking the surplus have now turned net borrowers in the market. So that's also one of the reasons why fresh money is not coming into so many of the liquid schemes.
Sajid, thank you for that. But the tide could be turning. The clamour for more rate cuts and the record borrowing plan announced in the budget are turning fund houses in favour of shorter-term bonds. Karthik is here to tell us why perhaps the sentiment is turning. Karthik.
Thank you, Harsha. As expectations grow of more rate cuts on the back of slowing inflation, bond fund managers are more bullish on the shorter end of the yield curve than on the longer end of the yield curve, which is more responsive to record gross borrowing program for the next year. So the markets are very concerned that the bond sale program is very, very heavy and supply is very heavy and as compared to the demand for the bonds. So that makes the longer maturity bonds less attractive to debt fund managers. So if you see that what is happening is, if you just look at the 10-year bond, the yield is almost at the same levels, while for the 3-year and the 5-year bond, the yield is down more than 20 to 25 basis points. So that reflects their optimism that the shorter end of the curve would rally more in response to the RBI's rate cuts and the liquidity measures that the RBI has implemented. And while the longer end of the curve would be reacting negatively to the bond supply.
Thanks so much for that, Karthik. Let's move on. India has revoked Pakistan's most favoured nation status after the horrific Pulwama terror attacks yesterday, which led to 14 soldiers losing their lives. The Cabinet Committee on Security Affairs met earlier today, passed a resolution asking all other nations to isolate Pakistan. Countries like the US have already come down hard on Pakistan, asking it to crack down on terror units like the Jaish-e-Mohammed, which has taken responsibility for the attack. Home Minister Rajnath Singh is visiting the area today. He'll hold an all-party meeting after he comes back from Jammu and Kashmir. The Congress has said that it will back the government on any move that it makes to fight terror.
हमारे सुरक्षा बलों को पूर्ण स्वतंत्रता दे दी गई है। मैं देश को भरोसा देता हूं कि हमले के पीछे जो ताकतें हैं, इस हमले के पीछे जो भी गुनहगार हैं, उन्हें उनके किए की सजा अवश्य मिलेगी।
The Ministry of External Affairs will initiate all possible steps, and I'm here referring to all possible diplomatic steps which have to be taken to ensure the complete isolation from the international community of Pakistan, of which incontrovertible evidence is available of having a direct hand in this gruesome terrorist incident. The most favored nation status which had been granted to Pakistan stands withdrawn. The Ministry of Commerce will issue the necessary communications in this regard.
The aim of terrorism is to divide this country, and we are not going to be divided for 1 second. No matter how hard people try, this country and the entire opposition is going to stand together. We are going to stand with our Jawans, and we're going to stand with the government.
Out of time on the show. Thank you so much for joining us.
Lots more coming up.